The industrial zone of Singapore hums with the rhythm of steel and fire. Sparks illuminate the air, and the smell of molten metal lingers heavily. In that heat, a single company works quietly but purposefully: OMS Energy Technologies. At first glance, it might seem like a conventional manufacturer, but beneath that surface lies the beating heart of the global oil and gas infrastructure. To bring crude oil from deep underground to the surface, one indispensable system stands guard: the surface wellhead. It controls the enormous pressure beneath the earth and connects the wellbore to the production facilities above. A single design flaw here could result in catastrophic blowouts or uncontrollable leaks. This is a domain where precision is not optional. It is survival, and only companies with decades of proven technical mastery, rigorous safety records, and international certification can compete. OMS Energy Technologies embodies that pedigree. Headquartered in Singapore, the firm operates across Saudi Arabia, Malaysia, Thailand, and Indonesia, and boasts over half a century of technological legacy. On May 13, 2025, it achieved a milestone: an initial public offering on the Nasdaq. The stock debuted at $9 per share, issuing about 3.7 million shares and raising approximately $33 million. In most cases, this moment marks a company's coming of age. IPOs tend to attract strong investor enthusiasm. Stocks often climb in early trading, or at the very least hover around the offering price for months. But OMS Energy Technologies defied that pattern. Within weeks of its debut, the stock began a steady decline, sinking to the mid-$3 range within months. For investors, it made no sense. Financial statements were solid, profits rising, and liabilities well managed. The most recent filings showed revenue of around $200 million and net income of roughly $44 million. That's not a struggling company. With a price-to-earnings ratio of just 3 times, the valuation was inexplicably low compared to industry peers. By any conventional metric, this should have been a bargain, and yet the market turned away. The first explanation was predictable: the lockup expiration. After an IPO, insiders are restricted from selling their shares for a fixed period. When the restriction lifts, short-term price dips can occur as those insiders cash out. But such dips are normally brief, lasting a few days or perhaps a week before rebounding. In OMS's case, the fall stretched for months. It wasn't normal profit-taking. It was something else. The second theory blamed emerging market exposure. OMS had expanded aggressively into volatile regions like Pakistan and Indonesia, and where currency swings, regulatory barriers, and political instability often spook investors. But again, such risks are nothing new to global energy firms. Normally, strong revenue growth and contract execution would offset those fears. OMS, if anything, was performing better than before, especially after successfully installing a new smart wellhead system in Pakistan, a major technological feat. It was taking calculated risks and delivering results. Yet, the stock kept falling. So what could explain this? A closer look at trading data reveals something curious. Repeated blocks of large volume sell orders appearing at regular intervals, followed by sudden spikes in volume and sharper price drops. This wasn't the chaotic rhythm of individual retail trades. It looked deliberate, patterned, almost mechanical. Such behavior often signals one thing: accumulation under suppression. One plausible hypothesis is strategic price control, an orchestrated effort by certain entities to depress the stock temporarily, accumulate shares quietly, and gain significant ownership at a discount. In markets where information asymmetry thrives, such tactics can go unnoticed for months. If true, this would mean the market's judgment of OMS's value wasn't organic. It was engineered. This case matters because it reveals a deeper truth about modern markets. They are not just governed by numbers, but by psychology, power, and access to information. When a company with clean financials, real products, and global clients sees its stock punished without reason, it challenges the very premise of efficient markets. OMS's story shows how easily perception can overpower fact. Even now, OMS Energy Technologies continues to post profits. The global demand for oilfield infrastructure remains strong, and wellhead systems are indispensable to that supply chain. The company's operations are diversified across regions and supported by decades of client relationships. Fundamentally, little has changed except for the price. The disconnection between intrinsic value and market valuation remains as striking as ever. Such dislocations are not accidents. They are signals. They may indicate hidden hands shaping outcomes, or simply a market too distracted to notice real value. Either way, investors are left facing the same haunting question: what is being hidden and by whom? The OMS case is more than a mystery about one stock. It is a parable about modern capital markets. It reminds us that even in a world of algorithms and transparency, manipulation can still thrive in plain sight. The challenge, as always, lies in seeing what others choose to ignore. ValueStir invites you to share your thoughts and leads. If you know of any listed, unlisted, or soon to be listed stocks or cryptocurrencies worth investigating, leave your suggestions in the comments below. We might feature your pick in an upcoming episode. Your insight and curiosity shape the stories we uncover. And to all who watch, subscribe, like, comment, and share our videos. Thank you. Your engagement fuels our mission to deliver deeper, sharper, and more revealing analyses of the world's most intriguing market stories. This was ValueStir.